welcome to 2017. Happy New Year to everyone. I hope you had a nice festive break and raring to go for the new year. As Deutsche Bank put it in their report this morning, if you've been off work since before Christmas, then you haven't missed much. Perhaps the stat to best give you proof of that would be for the DAX. Let me just enlarge this chart. I've got daily charts here across my screenshot. This is the DAX, obviously just looking at the launch through the roof in December. But then what I wanted to just point out was actually last week. This big green candle here was yesterday, so the DAX and some other European markets were open yesterday. Very low volumes, but it didn't stop the DAX, well, I guess on low volume, popping up through the highs. But if you look at the candles preceding that, then we had an incredibly flat week. And in fact, actually, and here's the stat, the DAX had its least volatile week for 20 years. So that sums up and really just displays the fact that last week nothing happened whatsoever. This is quite a good chart, though, really to just talk about what happened into the back end of last year, and then, of course, new year now. So it's everyone's trying to look ahead and trying to sift through the risks and see what's on the horizon. But obviously, in the end, the year finished incredibly positively for a lot of these risk assets, particularly for equities. If we just had a look at December, I'm going to change my screenshot here. Again, just taking the Deutsche Bank early morning read report this morning and looking at they select, I think it's 39 different assets here, and they at the end of each month give you a chart in terms of comparing their performance, and this is all in US dollar terms, okay, so taking out the currency effects. And so for the month of December, you can see that the left hand side here, which are all the best performing assets, I mean most of these are equities, of course, and the best performing equity market of all of them in that month was the Italian stock market on the rebound post Renzi loss. And in the end that seemed to be priced in, and in the end we've had a lot of activity on the banks with regards to Italy agreeing some kind of bailout, and so this has just calmed the nerves for now. So this is rebounding off depressed levels more than anything. Russia's obviously been a good performer since the Trump election win. Oil up here as well, both WTI and Brent knocking in 8% plus returns. But as you can see, most of these are equity indices with commodities. That was the kind of theme into the end of the year. Strong risk on push. On the right hand side, you've got the Shanghai Composite underperforming. You've got your kind of precious metal, copper is not a precious metal, gold and silver over here on the right hand side, but copper also suffering a little bit. But there's definitely a China and let's say a metals vibe to the right hand side of this chart, the underperformers. And then you've also got the likes of the Eurodollar and cable, as both of these currencies depreciated notably. I mean, let's just take a look at that. If I switch back to the charts, certainly important moves into the end of the year with regards to, let me just set this up and get the cable chart here on the daily time frame, and I'll just get the Eurodollar daily chart alongside it. And there was a little bit of a weird situation, and let me just go actually quickly to a 1 hour chart, because we've had a decent dollar strength this morning. Dollar index back up through 103 handle, and this has led to the Eurodollar on the downside. Cables trading around the bottom end of the day's range right now as well. But wanted to just point out what happened at the beginning of the session on the 30th, so the end of last week, the 30th of December's session. We had a brief, almost like very mini flash crash with the euro going through an aggressive spike, which then got immediately half of it reversed, and then in fact all of it as we went through the rest of the morning. But this was nothing. It wasn't off a news event. If you're looking at your charts this morning and thinking, wow, something must have happened, well, it didn't, and it just seemed to be more of a technical and then an algo driven very low volume. Of course, this was 11 p.m. on actually the 29th of December, and of course no volume, and a technical level got breached, and then algos came in, it stripped out a very thin order book, and you got a very large spike. This is nothing other than very thin market sort of volatility. And as you can see, here we are now back to really the vibe we had at the end of last year, which was definitely euro weakness and certainly pound weakness as well. The euro weakening because of the, twofold, I guess. Firstly, the fact that the ECB managed to pull the rabbit out of the hat, where they tapered their QE program, remember, by reducing the monthly purchases from 80 billion down to 60 billion, which is a hawkish move, but then of course a whole bunch of other dovish promises with regards to extending the QE program into 2018, and that ended up being the dominant force, and so we had euro weakness. This then was added to by dollar strength. The other big major monetary policy event of December was the Fed hike, and even though that was fully priced in, it was perhaps some analysts saying that there was a slightly more hawkish vibe to the way that the Fed altered their dot plot matrix and implied that we're going to get 3 hikes in 2017. So euro weakness, dollar strength. You then got some sterling weakness as well, I would say, as the Brexit sort of situation perhaps shifted back towards the more hard Brexit scenario. And so, some commentary from Theresa May. Yes, we're going to carry on as planned. We're going to trigger Article 50 before the end of March. Then the idea that, the 2-year negotiation period was plenty of time to fully negotiate an exit. And so you got a little bit of sterling weakness coming into the end of the year with a kind of key break of the mid-November low around the 123 handle. You had a spike higher on the 30th of December, but this is more of a correlated move to what happened to the euro, even though the euro is obviously not part of cable. There was a correlated pop higher up to 124, but as you can see, we're kind of back below that 123 handle here, perhaps looking south. So that's the situation on the current of the two kind of main currency pairs here. But yeah, just thinking about the end of last year, just to try and get your brains into gear. Obviously, the year was dominated by Brexit. It was dominated by Trump. It was monetary policy moves by the ECB and the Fed, and now it's kind of very much thinking ahead and just scratching our heads still a little bit. And if we have a look at the S&P now, for example, just scratching our heads a little bit, or perhaps not scratching our heads, but looking on with a very healthy dose of skepticism with regards to the positivity of equity markets. Since the major, on this time frame I'm showing you here, since the Trump win, of course, all that's happened is we've launched to the upside, and this is, I guess the big question for 2017, I would say right now at this point, the start of the year, the first full trading day of 2017, I think the big overhanging question is, have these markets, are they too optimistic regarding what Trump can deliver? I think that a lot of this big move, of course, into the end of the year was the idea that Trump, we're going to get, if you have a spectrum of how Trump's move into the White House is going to pan out, and you had the spectrum of it's going to pan out the best it possibly can to the worst it possibly can. Well, at the moment, markets are pricing right up towards the best it could possibly go, okay? And that is where he delivers a big, huge fiscal stimulus program, and he doesn't cock it up with regards to policy error or kind of flaming some kind of nationalistic trade war. Okay, so we're right up towards the pricing, the most possible best outcome, which I think is too optimistic. So we'll see. I think this is the big thing. Trump doesn't hit office till the end of the month. I think markets are pricing in too much too soon for Trump. So personally, I think, I'm looking at this with a healthy dose of skepticism, and so this will be the first challenge, I guess, for these markets. Can they hang on to these all-time ever highs as we track through the month and we get ever closer towards Trump getting into the White House? Another big theme, obviously, post-Trump, and in the opposite way, and then let me enlarge my T-notes chart. And another really important thing for 2017, what happens to bonds? This is T-notes selling off sharply since Trump. This is a big rally in yields. We've had a little bit of a bounce last week, but of course we're still right at the bottom of this move. And so the other big question for this year is, what's going to happen with the bond market situation? Are we going to pick up where we left off last year? Are yields going to continue to rise or not? What's going to help with this, of course, is Trump and then the Fed. And we're going to get, one of the highlights perhaps of the week this week will be Wednesday evening when we get the minutes from the Fed's meeting from 3 weeks ago. Of course, the meeting where they hiked, the meeting where they upped their interest rate hiking trajectory in 2017 to 3 hikes. So we're going to get the minutes from that meeting released on Wednesday. That's tomorrow, which perhaps will give us a bit more insight, just how convinced is the entire committee that they're going to need to start to become more hawkish. So that of course is going to play a big role. But will this trend continue? And if it does, is that going to lead to tighter monetary conditions generally for the underlying economy? And is this going to be a drag on economic growth? There's one thing that may well help or help to prevent a continuation of this sell-off on price and a rally on yield, and that's the Bank of Japan. They've got a policy where they're not going to allow their 10-year bond yield to go above zero. It is above zero, but not by much. And so how committed are they to that policy? If they are committed and start ramping up purchases in order to suppress their yields, well then, and of course the ECB are continuing to buy bonds, well then, this should be a natural sort of hindrance for US bond yields to rise. And so we'll see. It's going to be really interesting over the next week or so to see whether US bond markets are going to flatten off now, whether they're going to rebound, or indeed is this bond yield rally going to continue. So this is a big thing. I'd say the kind of other big factors obviously are politics in Europe. Just thinking ahead about what's going to happen, let's say Q1 of this year. Certainly you can absolute guarantee that politics in Europe is going to be a strong feature. To start with, it's going to be about Brexit. And as we move towards the Article 50 triggering, this really then properly brings, or really gets this thing started. And what I mean is the negotiation phase, really is only going to get properly underway once Article 50 is triggered. Only then are we really properly going to see how Europe are geared up here to begin this process. And I think, you surely got to get some uncertainty. I would say sterling weakness is something to look for. And let me just enlarge the cable chart and think back to what happened last year. And we did get a spike at the start of October to the downside on cable, took us down to the 120 handle almost. We had sterling weakness into the end of the year. And so looking for that to continue really. Any movement below the December low, 122.27 on the futures, should open the door for a nice move down to 121 and then a kind of test of last year's low. So look for sterling weakness as we get closer to Article 50 being triggered, and then the nervousness really starts to ramp up a little bit. So Brexit, then of course later in the year, Q2 will be French presidential elections. We've got a Dutch general election. We've got a German general election, of course. So politics was a massive feature of 2016, and it's not going anywhere. It will continue to absolutely be a big dominant force this year as well. Just checking in on oil actually, and an important price to be aware of, WTI crude futures. Check out the high that we had mid-December at 54.51. And this last week and again today, we're just shy of that at the moment. And of course, another big thing for the very start of this year, January, are OPEC and indeed non-OPEC producing nations going to stay faithful to their commitment that they made to each other? They're going to cut production, apparently. So are they? Because the commitment was to start to cut production in January of 2017. So we're going to see straight away whether there's any evidence of that happening or not. At the moment, markets are still happily pricing that it's probably going to happen. If it does happen, there's certainly more upside to come. There's still some, I guess some skepticism as to whether it's going to happen, and that's because of what's happened in the past, where OPEC have agreed on production cuts and actually none came. So there's implementation risk here. You can certainly get a pop up through $55 if we do see that OPEC start cutting and Russia start cutting. If I go to a weekly chart, we have been higher than this. Actually, let me go to a monthly chart. Mid-2015, we went up to, let me just check, 62.58. This was in the May of 2015. So if that's the kind of next major upside resistance barrier, with perhaps $60 in there as well as a nice key sort of psychological level. So there's certainly room to move higher. But if we track through January and the more we go through the month, and if we see that, hang on, nobody's cutting yet, well then this skepticism over whether it's going to happen or not will ramp higher, and you'll probably get a sharp move back below $50. And you're starting to look south. I mean, if they don't cut production at all, and if relationships within OPEC really start to fracture again, then you can absolutely see a move back down towards the November lows, down around $42. So there's plenty of room for movement in either direction here for oil, despite a very strong move to the upside over the last 6 to 8 weeks. We can get more moves higher, but equally, of course, scope for a big move lower as well. So certainly the oil space is something that's important to keep an eye on. Let's have a look at gold, which had a particularly important technical move into the end of last year. Let me draw a couple of lines. 1250 was important, and then indeed 1200. We broke these. If I go to a weekly chart and look slightly longer term, then you can see that we are tracking down through the range that was set in the first half of 2016. We are kind of tracking down through that at this point. So technically you would say, long-term technical analyst would be looking at this and thinking, well, perhaps there's still room to move lower. But we'll see. I mean, if any of these kind of risks we've got ahead of us materialize, well, of course, gold will benefit from that. And then the other thing to think about is inflation. Let me just tell you what's been going on with economic data so far this year, even though we're obviously only working day two, and indeed working day one for most of us, but we did have Europe open yesterday. So let me just show you a couple of things here. We had some manufacturing data released from France yesterday. And this led to, so this is the manufacturing PMI numbers. These are the final readings for the month of December. And it showed that in France, manufacturing output is growing at its fastest rate since May 2011. So obviously very good news here. But one thing to note about this report, strong inflationary pressures persist. If we look at Germany's equivalent, well, here we've got, again, very strong headline numbers. So German manufacturing growth at its highest rate for 3 years. But then check out this, the weaker euro contributes to steepest cost pressures in 5.5 years. So I was showing you the FX markets a minute ago, and the euro certainly weakened strongly, and this should feed through to inflationary pressures, particularly for these kind of manufacturing exporting giants. So that's something to think about. We also got Chinese manufacturing numbers yesterday, and indeed over the weekend also. And here yesterday we had the Cayenne sort of more sort of smaller manufacturing production numbers, and these results came in very strongly as well. In fact, best conditions we've seen since January 2013. So generally, we got quite a positive start with regards to manufacturing data, and this has helped, certainly for risk assets to continue their positive vibe. You saw, if I switch back to the charts quickly, of course, the DAX, you saw this earlier, popped up 1% yesterday. So, slight positive vibe. We'll see how long this lasts. But, we've definitely got a very busy start to the week. And if I showed you the economic data calendar for today to start with, just in 7 minutes' time, we've got a lot of German data in the shape of their unemployment report, but then we've also got the regional CPI numbers. So continuing with the theme of inflation, Germany will deliver their regional numbers. We've already had a couple of these earlier on. Saxony, for example, indicating that their year-on-year CPI reading in December moved up to 1.8%. That's a pretty strong move higher. In November, it was 0.8%. So you've had a 1% increase in the year-on-year inflation rate. On the month-on-month side, also strong move to the upside, where we had a month-on-month reading at plus 0.9%, when last month in November it was just 0. So, certainly the first set of numbers from Germany indicating that the whole theme around, inflationary pressures are going to build in 2017. This data certainly initially looks like that's going to happen. Outside of that, we've got some manufacturing data from the UK at 9:30. German inflation numbers throughout the day, including the headline number at 1 o'clock this afternoon. But I'd say definitely the most important data left on the calendar for today is this 3 p.m. number. And that's the US ISM manufacturing print. Last month, that's November, it was 53.2. So that'll be the most important number of the day. That's this afternoon. But certainly a very busy day very busy week on the calendar. Obviously, it's a shortened week because of the bank holiday. But let me just list off some of the things that we've got. Obviously, it'll culminate in Friday's non-farm payrolls report. But we've got, well, I won't go through all of these. It's actually quite a big list. But I guess the highlights are all these manufacturing PMI numbers. They're the CPI numbers from Europe that we're going to get tomorrow. We've got the Feds or the FOMC minutes released on Wednesday. Thursday, we got the ADP employment report. Plus the usual kind of jobless claims and so on. Friday, we've got Eurozone retail sales, as well as the US payrolls report. Week one of any month is normally the busiest, and certainly week one of January is not kind of letting us down on that front. So it's definitely going to be a busy start to the year. Let me show you a chart, just switching tack slightly, just to kind of describe what's going on this year. I was reading an FT article yesterday, actually, and it was titled Markets Outlook, the big issues facing investors this year. Obviously, there's the Donald. He's top of the list. I'm not going to go through all of these. I'm just going to read out the headlines to point out what analysts are really kind of looking at and worrying about. So, of course, Trump risk is top of the list. Are markets at risk of a Trump disappointment? I've already talking about that. How will Europe and the UK handle Brexit, of course? So these are the big two themes. Oil, are OPEC going to cut or not? Another theme in here was global banks, and perhaps top of that list, Italian banks. So that's the other theme. Is the worst behind us on the Italian banking kind of mini crisis? I personally think it's highly unlikely the worst is behind us, but that's my personal opinion. At the moment, markets are happy to perhaps assume for now that the worst is behind us, but I think that's optimistic. Are financial conditions going to get tighter? This is talking about the bond yield rally. Emerging market tantrum. Has that got further to run? With the strengthening dollar, with increasing yields in the back end of last year, emerging markets kind of suffered a little bit. Of course, the Mexican peso top of that list with regards to Trump's win. How's this going to pan out? Not to mention what's going to happen with the kind of migration situation in Europe. Certainly, unfortunately, terrorist attacks sadly are inevitably going to continue to be a feature. How does that play out with regards to German politics? And then finally down here, and something that was interesting, and I didn't realize this, but thinking about IPOs, here's a good stat. Last year, 2016, saw the lowest listing of US IPOs since 2003, which is pretty interesting. Is that going to continue to be a theme or not? And now the dollar's strengthened. How's that going to impact on corporate America? Because we are going to get Q4 earnings that will begin in a couple of weeks' time. So that's something else to look out for this month. So definitely lots happening. Lots of uncertainty ahead. Lots of big kind of minefields to navigate through. I think 2016 was a pretty extraordinary year, and I think 2017 is going to have to be equally so, I would say, just from the sheer political uncertainty. And perhaps to leave you on a final chart, if I can find it, yeah, here we go. Last chart of the briefing to sum up the kind of uncertainty. This is economists and their projections for US growth in 2017. And what we're looking at here is, like a bell-shaped curve, as you'd expect. And you've got the bulk of analysts and Goldman's in here, representing the middle ground and the most likely outcome, which is 2.3% growth, which would mean a continuation of below trend. But then, of course, check out the main thing about this chart is not what the majority think, it's the extreme nature of the range, because on the pessimist side we've got right down at minus 1.5%, and then on the optimist side you're right up at plus 3.5%. I mean, that is a 5% range on US economic growth rate for 2017. I cannot remember, I'll have to look at the stats, but I certainly can't remember personally ever seeing a range anywhere near that. So that just points to the fact that there's a hell of a lot of uncertainty. We don't really know which risks will materialize, which won't. Is Trump going to deliver all of the goodies with none of the risks? In which case, right, fine, maybe growth can accelerate. Or is Trump going to be a bit of a car crash? In which case, well, hang on, we might be in for a recession. So, I think Trump particularly will be an interesting factor to keep an eye on, of course. Right, that's it for now, guys. I'm going to leave you to it. All the very best for your trading accounts and everything outside of that in 2017. We wish you a very profitable and fruitful year ahead. Okay, thanks very much.